Hi, everyone. I'm Amber. I'm venture lead at New Order. I'm managing our DeFi portfolio in an accelerator program, DeFi Basecamp. And as you know, we also have a incubation arm where we research, build, and launch new DeFi protocols. So since inception, December last year, we have launched Redacted, a protocol on liquidity solution, and H2O, a on-chain data-backed stable asset, Frogs Anonymous, a crypto research platform, and now Y2K, a new DeFi primitive for users to hedge or speculate on the depegging risk of stable assets. So we'll go into the project in a minute, but in one sentence, Y2K's first product, Earthquake, is a fully collateralized insurance vault where on either side of the vault, users can take opposite positions on the volatility of a pegged assets like USDC or DAI. So we have one of the founders, Crypwalk, here with us today to tell us more about Y2K. I believe this is the first ever founder interview. I'm super excited to learn more. And I will also have Drej on the call. He is the research lead at New Order and an internal policy advisor to Y2K. So hi, Crypwalk and Drej. Would you like to introduce yourself?
Yeah. Thank you so much, Amber. Yeah, and I'm Crypwalk. I've been in DeFi for about a year now. Was one of the early contributors at Redacted, and yeah, I'm gonna be the business lead and one of the founders of Y2K going forward, and mainly focusing on the business development and also the policy side of things.
Hey, I'm Drej. My background was actually in TradFi. I worked for a while in OTC derivative trading. Then I went into academia and did some computational physics stuff. Eventually got into crypto and have been in DeFi for a while now. And yeah, most of my work at Y2K is like centered around internal policy, designing vaults and products and stuff like that.
That's great. Thank you. So pegged assets are supposed to have like stable value. Of course, that's not what we've seen in the market. It's common for like fully collateralized or even over collateralized assets to deviate from its pegged value. Not to mention like algorithmic ones. So why is that pegged assets often experience like short-term price volatilities?
Drake gave you a little bit more color here, but especially stable coins, right? They're designed to oscillate around the dollar peg. So usually they have mechanisms within the coins where once they're below $1, there's a mint function that brings them back up to $1, and once they're over $1, they get burned back down to $1, and usually that has to do with sometimes the underlying collateral. Maybe there's deviations in price with the underlying collateral that backs whatever pegged asset or stablecoin it is, and sometimes, like you mentioned with UST, as just the economic design. There are flaws inherently in sometimes a lot of the algo stablecoins, and when like the credit isn't up to kind of like what's being lent out, usually that also causes deviations in the peg.
Yeah. In general, we like to look at we like to classify sort of these vaults as under two categories. We have like high risk vaults and low risk vaults. The high risk vaults, they're designed for people to speculate and hedge against just pure volatility in the underlying asset. These usually have nothing to do with depegs, but rather just trading the price deviations from the peg. And like to give a quick example of that, like let's say 99 cents on DAI, like nobody would really consider that a depegging event. But at the end of the day, it's something that can happen and does happen, and it does happen relatively frequently if you think about it. We like having these types of vaults included because first of all, it does drive a bit of user engagement. There's roughly a 10% chance each week of a quote unquote depeg event with these types of vaults, and having these things, let's say depegging relatively frequently, it actually just enforces the use case for our product for more serious events, for like some of the lower strike vaults. Aside from that, it's just generally good for the protocol as we have higher strike vaults that bring they bring people into, like, I don't want to say the word bet, like they're not necessarily betting, but to just speculate on volatility, right? We also have like lower strike vaults, which are like lower risk, we say, and these are like more traditional hedging vaults, right? Like let's say like 95 cents or 90 cents, and we can get into this a bit later. Like we do have our own ways of determining what strikes to use for these kinds of things as well.
Yeah. Because those price deviation, unnecessary depegging, that happens all the time. So that's kind of formed the idea of launching Y2K to create an avenue for users to hedge those risks. That really makes sense. So can you just give us an overview of Y2K? And I know Earthquake is one of the first products. And how does that work?
Yeah, so I could go into Earthquake. So Earthquake is our two-sided it's a hedge and a risk vault, and you can think about it as the hedge side as people are able to put up, users are able to put up ETH as premium to hedge against a particular stable coin or pegged asset depegging, and then there's the other side where users can deposit ETH as collateral to underwrite the risk of a certain stable coin or pegged asset depegging. And the way those vaults are designed is that one, the price of the insurance is determined by the ratio of collateral to premium. So it's essentially determined by the market, which we thought was kind of the most efficient way to kind of price these things, right? To let the market determine what the price of the risk should be for certain asset depegging. And the way the vaults function is that if there isn't a depegging event during a 30-day epoch or a week epoch for our higher strike prices, then the premium that is deposited in the premium vaults is liquidated over to the collateral depositors for their service, which is underwriting the insurance risk. And if there is a depegging event and the strike price is hit, then the collateral is liquidated over to the premium side, where depositors get covered for the hedge that they took out, but the premium the premium from them that they deposited still flows over to the collateral depositors because that just is the price for insurance, if you want to call it in these cases. And once users deposit ETH into the vaults, they emit ERC 1155 tokens, which denominate their positions in the vaults, and those positions are able to be traded on our secondary market, which we'll go into later on, I guess.
Yeah, so that's very clear. So, like for example, I hold DAI in my portfolio, but I think DAI might depeg or like has some price deviation for the next 30 days. So what I would do is to set a strike price where I speculate how far from the peg it will go, and then if it reaches this price, I'll get a payout, right?
Exactly.
So in a way, I'm buying like volatility option. And for the option sellers, as you mentioned, like the underwriters, they are taking on a risk of price volatility. So they will get a reward on how much ever liquidity they put in.
Exactly, correct. And the way that the value accrues from that process to the protocol is that at the end of the epoch, whether epoch ends with a DPEG event or without a DPEG event, we take a 5% fee on any kind of rewards that are claimed at the end of the epoch. And from that 5%, 70% is distributed to VE Y2K lockers, and 30% of that is redistributed back to the Y2K treasury.
Yeah, that makes sense. That's the business model. That's great. So I do have a lot more questions on the product itself. But first I want to ask, since you call it insurance vault, how does Y2K differentiate from like traditional insurance protocols like Nexus Mutual Insurance?
Yeah, definitely. So with those protocols, usually what you have is an arbitration process that is off-chain. So there's a lot of obfuscation there, and there's an asymmetry of information for the users where, for example, if you had a claim that was denied, there's not a lot of transparency there for you to know exactly what parameters or what factors led for you not to be covered. So the way our system works is it's fully transparent, and it's all done and settled on chain. So once the epoch closes, based off your position in the vault, you know exactly the kind of amount you stand to get paid out and you're covered for. And in the case of a depegging event, and once that depegging event happens and the Chainlink Oracle does give our liquidator engine the feed of that strike price getting hit, then the liquidation happens instantly. And in the next block, literally the next block, the user would get paid out. So it's a much more efficient and much more transparent way of taking out a position against one of these particular pegged assets depegging.
That's awesome. So also to my understanding, Y2K also work with DeFi protocol owners to build a customized vault for them.
Yes.
If the protocol themselves put up money in those vaults to underwrite depegging risk, it kind of like shows the confidence and stability of their stable assets. So it builds the user trust in a way. And even if there's no depegging event, it creates a monthly revenue for those protocols as well.
Yeah, exactly. That's precisely, yes. It's a vote of confidence for your users to show that you're backing your own asset. And through the conviction you should have, obviously, in your own asset, you can use that to also earn ETH yield for the treasury. And if you're able to deposit a sufficient amount of collateral and attract more people to deposit in the collateral vault with the DAO or the protocol, it also makes the premium cheaper, right, for the other side to get coverage, which would attract more premium and creates a flywheel where you'd also generate more fees that way as well.
Yeah, makes sense. So it's servicing both the retail users and the protocol. Great. So without going into like too much technical details, how do you calculate a payout and price those volatilities? And from like, if I want to use this protocol from user perspective, what are some factors taken into consideration when I set up, like, for example, the strike price?
Yeah, I'll quickly get into that. So the protocol itself is going to be determined. Like, it's going to be setting strike prices for each individual vault. Users will have the ability to pick which ones they want to deposit to based on their own, hedging or risk preferences. The way payouts are calculated is actually very simple. It's a very straightforward bonding curve. And I should kind of preface that it's twofold, right? Like, you've got two products that we're launching with. There's this primary origination, which happens in the vaults, and then there's a secondary market in which people can trade the vault tokens that they receive after depositing. So I'll start with the vaults themselves. During the deposit period, so there's a deposit period during which users deposit in each side of the vault, and while that period's open, it doesn't matter whether the asset depegs and then regains peg. Like the epoch doesn't start until the deposits are closed. So what that means is that there is potential for the yield to change and the expected payout to change after deposits are made due to this bonding curve mechanism. But the expectation is generally that markets are somewhat efficient, right? So if a lot of, as Crypwalk alluded to earlier, if a lot of Ethereum gets, thrown into this and into the vault that's just buying insurance on a certain pegged asset, the the payout for the other side gets high enough that it should attract liquidity on the other side. Otherwise, there is a certain market inefficiency. So the payout itself ends up just being very straightforward. If, let's say, 1 Ethereum is deposited into the premium vault and 100 Ethereum is in the collateral vault, if a depeg event was to happen, it would be a 100-to-1 payout for everyone that deposited in the premium vault. And if there's no depeg event, it just becomes a 1% payout. And that comes out to 12% APR for a monthly epoch if someone's selling insurance, and that ends up being a pretty decent yield, especially in these market conditions. And if someone has conviction, in this pegged asset, it just becomes even more attractive. For example, we determine the strike prices like using a couple of different models. In general, like, it isn't our job to price these assets, but we do want to have a certain guideline of, okay, how much do we expect these vaults to depeg? We don't want to create a bunch of vaults that are just farmed that'll never depeg, or that'll happen once every 3-4 years. As I mentioned earlier, we have like some higher strike price vaults, and these, like, just because of the oscillatory nature of stablecoins around like a very small domain, when you really zoom in on it, there are mechanics that just kind of cause the stablecoin to, if you can look at distributions of just price movements. If a stablecoin's below $1, for example, it's much more likely to go up than it is to go down around a very small, and I should say around a very small region around the price. If you really zoom in, if you zoom out, if a stablecoin drops to 95 cents, all of a sudden its price is very path dependent. There's a reason it dropped that low. It's because it's implying a 5% probability of a depeg. And then, we wanted to create like sort of a guideline of some of our proper, I suppose, hedging vaults. We want them to depeg once every 12 to 18 months based on these models, right? And that's obviously not a guarantee, and we're not pricing these things and determining payouts. Of course, it's the market that's doing it, but we do want to have that as a sort of general idea. So, we played around a lot with the pricing of these things. And, one of the things we like to use is the Merton model. It's a fixed income pricing model for determining the probability of a bond defaulting. And, basically the way that works is like in traditional finance, you look at the volatility of a stock and you use that volatility to price like a put option on the bond. In very simple terms. And that can be translated to some assets that are collateralized, such as DAI, where you look at the stablecoin as a bond and you look at the collateral as like the equity. And then you can price roughly the probability of DAI depegging by looking at its collateral volatility. Now, if someone isn't like interested in depositing in vaults because they might be afraid of being diluted or because they think there's a depeg imminent that could happen during the deposit period, you can actually look at the secondary market as zero coupon credit default swaps, because the vaults, like the liquidity in both vaults is it's already set, so the payouts are fixed. So if you want to go and hedge a specific amount of ETH without any risk of dilution, it's very straightforward to just go into secondaries and buy one of these vault tokens. So we want to design this for everyone, really.
That's great. So you mentioned you will support some assets on your soon launched mainnet. What are some assets that's going to be supported?
Yeah, so we'll have Frax, MIM, DAI, and USDC, and we also would have a USTC vault as well.
That's great. Can you tell us more about the Y2K token?
Yeah, so the Y2K token, there's the ERC 20 Y2K token that would just be traded on DEXs, and then there's the ERC the 55 token that you mint once you deposit ETH into either one of the vaults. And we would have our token generation event is going to be at launch. And if you do lock up VEY2K tokens, then you do have access to, as I stated before, the fee revenue from the vaults and the secondary market Wildfire, and also governance in terms of creating additional vaults, and also once we have our gauges live, directing emission to specific vaults as well.
Amazing. So I think Dre alluded to it before. On top of Earthquake, there are other products you're thinking about launching under Y2K. Can you tell us more about like Tsunami and Wildfire?
Yeah, So Tsunami is more in the R&D phase, but that's from a really high level. It's just our take on money markets on Arbitrum. But Wildfire is a little bit more interesting. That's a product that we have code frozen on, and it is ready to go. We're just waiting for the 0x interface to be on Arbitrum. But Wildfire will be our secondary marketplace for the Earthquake positions. So while your funds are locked up for either the week in the higher strike vaults or the month in the lower strike vaults, this adds a layer of capital efficiency where you're able to trade in and out of your positions on this secondary market. And as Dre said before, if you're a user that wants to come into these vaults and you weren't able to deposit before the epoch started, you can also enter one of these positions through a secondary market, and you'd have a right to the payout at the end of the epoch. And the way that revenue kind of accrues for the token holders through Wildfire is that we take a 0.25% trading fee on every trade on Wildfire, and of that it'll be the same kind of revenue split for the Earthquake vaults. 70% of that would be going to VEY2K lockers, and 30% of that will be going to the Y2K treasury.
Awesome. That's very clear. So we talked a lot about the product itself. I want to get back to a bit bigger picture here. So as founders, so what's your vision on Y2K and how that vision really contributes to the overall development of DeFi ecosystem?
Yeah, absolutely. And I'll give a little bit of color on it and then let Dre go in as well. But we think it could be kind of a new DeFi Lego, right? That allows people to, it allows people to, a lot of people in DeFi have a pretty big risk appetite. So it allows people to take kind of risk on different kind of experimental pegged assets, even new algo stables that might come out. People can have a way to kind of participate in those kind of products, and if it works, great, right? But also have a way to hedge against any kind of black swan event that can happen, or any kind of death spiral that happens typically with those kind of experimental designs. And it also allows people to better price risk for these different new peg assets, and especially the new stable coins like GHO and Curve that are coming out. Allows people to kind of price the risk of these new models as they hit the market.
Yeah, I'm going to leak a bit of alpha over here. One thing that we're actually looking at very closely is automated vault strategies. Like as Crypwalk mentioned, like we want this to be a building block within DeFi, but we also want to be one of the people, or one of the protocols, I should say, that are building with those blocks, right? And one of the things we want to do are, like I said, automated vault strategies. What I mean by that is a lot of people that play blackjack or that experiment with prediction markets, they use martingale strategies, right? What that means is, if you have a 50% chance of a 2x payout, what you do is every time you play, you double the amount that you're betting, and eventually you'll make back your initial investment, right? So long as you have enough capital. Now, obviously, that multiplier isn't always 2x. Ideally, for some of these vaults, it would be like 1.01x, etc. But we want to allow users to deposit a certain amount of Ethereum, and just over the 6 to 18 months, just allow the martingale to do its work. And if a DPEG does occur, if they do believe it'll happen at some point over that period, they can cover themselves over all of the epochs with one deposit. Another thing that we want to look at are structured products that use these vaults, and that could be as simple as spread strategies, right? You can buy insurance on the 98-cent strike and sell it on the 93-cent strike, and you end up funding one with the other. So you get a somewhat smaller payout, but you have a bit of a hedge there. And then one other thing that Crypwalk mentioned very briefly is we're looking at Terra Classic USD. We're actually going to be launching with a peg vault, and that's something we haven't talked about a lot. But we want to allow users to speculate on whether UST will ever repeg for some reason. So you get a payout if it hits 25 cents or 50 cents or something like that. So we think there might be a bit of excitement around that. It's a bit more speculative, obviously, but we've been seeing a lot of debate around this on Twitter, and we figured, why don't we give people a way to put their money where their mouth is?
Yeah, that's super exciting. And based on what happened with the Terra Classic, I think it went up like 600% just the last 30 days, something like that. Yeah, those are a lot of alpha drop here. So last question, I understand that the testnet is already launched on Arbitrum. So when is the mainnet launch?
Yeah, for sure. And first of all, we're in the part of the development process right now where we're just kind of making sure that the code is battle ready. So with these kind of contracts where we'd be asking our users to lock up funds with our protocol, our main concern is the security of those funds, right? And making sure that the contracts are bulletproof. So we've gotten the contracts thoroughly audited by Halborn. They've gone 3 rounds of audits on them. We've also gone through a peg shield audit. And we've recently started a code for arena contest for the contracts as well. And our CTO is also used to do code for arena audit. So we just want to kind of button up the security aspect of it. But in terms of that, once the audits are done and we've made the kind of appropriate adjustments to make sure that the code is battle ready, then we're kind of targeting a late September to kind of mid-October launch, right? Like kind of in that period. So like soon TM, like we always say in the space. But we'd be kind of over the next couple of weeks, we're going to be putting out a lot more communications to give kind of our users a clear idea of when the launch is going to happen and how to participate as well.
That's awesome. Thank you so much for being here today, Crypwalk and Drej. It's been so informative. Can't wait for the mainnet launch. And to our audience, if you have more questions about Y2K, please leave a comment below or let us know in our Discord. Follow and subscribe for more updates on new DeFi projects. See you next time.